Understanding how SARS taxes lump sums has always been a bit confusing for many tax practitioners, and this is not surprising. Firstly, there are two different sets of tax tables for taxing lump sums, and sometimes it's not always clear which set of tables should be used. Secondly, SARS's cumulative method of taxing lump sums makes the calculation more difficult. In addition, the lump sum amount shown on the tax certificate from the fund may not always be the amount to be taxed. Although there are two different sets of tax tables for taxing different types of lump sums, a particular source code does not always mean that a particular set of tax tables must be used for a lump sum. You see, the circumstances surrounding the payment of the lump sum often dictate how a lump sum is taxed. Once you understand the circumstances, you will find it a lot easier to work out the tax due on a lump sum. Before a retirement fund or an employer pays out a lump sum, they have to obtain a directive from SARS. The information on the directive should help to reveal more about the circumstances surrounding the payout of the lump sum and how it was actually taxed. When a taxpayer goes on pension from a pension fund or matures a retirement annuity policy, 1/3 of the RA policy value or 1/3 of the taxpayer's money in the pension fund may be paid out as a lump sum. Part of this 1/3 may be tax-free, and the balance of the 1/3 is taxable at tiered rates. The 2/3 portion of the taxpayer's amount in the fund has to be commuted into an annuity fund to provide a monthly pension. In the case of a provident fund, the 1/3 does not apply, and the entire amount is paid out as a lump sum. Part of this lump sum may be tax-free, and the balance taxed at tiered rates. SARS is looking into how provident funds can be brought into line with RA funds and pension funds, but for 2016 the current laws still apply. Let's have a look at SARS's tiered tax tables for taxing lump sums at normal retirement or death. SARS's Pocket Tax Guide for the 2016 tax year shows these tables. In this tax year, the first 500,000 Rand of the lump sum paid out at normal retirement is tax-free. The next 200,000 is taxed at 18%. The next 350,000 is taxed at 27%, and any balance over the lump sum of 1,050,000 is taxed at 36%. Lump sums paid from one of these funds at normal retirement generally has the source code 3915. Although SARS says that code 3901 amounts from employers and code 3920 pre-retirement withdrawal amounts will be taxed and treated the same, note that code 3901 severance packages paid by an employer will be treated as a lump sum received at normal retirement and will be taxed according to this set of tables. If a taxpayer makes what they call a 3920 pre-retirement withdrawal from a provident fund, for example, then this lump sum is normally taxed according to a different set of tables. So let's have a look at those tables in SARS's Pocket Guide for 2016. The pre-retirement withdrawal from a fund will be designated an income source code of 3920 on the tax certificate from the fund. The first 25,000 Rand is tax-free. The excess of 25,000 up to 660,000 is taxed at 18%. From 660,000 up to 990,000 is taxed at 27%, and anything over 990,000 is taxed at 36%. If someone needs cash and digs into their provident fund, for example, by making a pre-retirement withdrawal, then the amount they take out of the fund will be taxed according to these first 25,000 Rand tax-free set of tables. Once again though, certain circumstances could mean that this code 3920 withdrawal amount may be treated as a lump sum taken at normal retirement, and then the first 500,000 tax-free set of tables would apply. Now we could use a spreadsheet to illustrate and explain these examples, but the best way I can show you how these different tables work in practice is to use the Lumpsum extra detail screen in the Wintex software program. This is the Lumpsum extra detail screen in Wintex, which we will be using to illustrate various examples, because this screen shows the history of lump sums received from retirement funds, which is important when we later talk about multiple lump sums received in different years. Wintex will carry forward lump sums received in the past from year to year and show them here in the tax years when the lump sums were received. If you click on this blue I for Info button, then a text screen will appear explaining to you exactly how these lump sums are taxed. This screen also offers 3 columns catering for different circumstances surrounding the lump sums received. In other words, we enter the amount of the lump sum in either the column labeled Resignation, the column labeled Retrenchment, or the column labeled Retirement or Death, and the amount we enter is taxed according to these circumstances. Remember that where the full amount of the retirement fund is transferred to a preservation fund at retirement, then the source code would be 3920. This is because technically the full amount is not paid out by the retirement fund, but it is withdrawn from the retirement fund and transferred to a preservation fund. There is no tax implication in a case like this where the entire amount is transferred to a preservation fund, so you would not enter the amount on this lump sum extra detail screen in Wintex. If we have a code 3920 amount of 100,000 Rand on a certificate from a provident fund showing a pre-retirement withdrawal from the fund, then we enter that amount into the column labeled Resignation. We also have to indicate that this partial resignation from the fund is the last lump sum taken in this tax year. We select T for Taken or T for Tables button next to this amount, and this will indicate that the withdrawal set of tables is to be used. We will see how this indicating of lump sums taken and what tax tables are to be used becomes important when we look at multiple lump sums taken in the current tax year. If we bring over the auto summary window showing all the bottom line figures, we will see that the first 25,000 of the 100,000 Rand lump sum withdrawal amount is tax-free, and the balance of 75,000 Rand has been taxed at 18%. Now let's have a look at an example where a taxpayer went on normal retirement from a pension fund or matured an RA, and the taxpayer received a code 3915 lump sum amount of 600,000 Rand. So we remove our old example of 100,000 Rand pre-retirement withdrawal and insert our new example of 600,000 Rand lump sum received at retirement. We also select the new Tax for Taken or Tax for Tables button against this new lump sum. Let's have a look at the auto summary. We can now see that the first 500,000 Rand is tax-free and the balance of 100,000 Rand has been taxed at 18%. Now let's look at the taxpayer who made a code 3920 withdrawal from his provident fund and discuss different circumstances. What if this taxpayer had been suddenly retrenched at an age where the taxpayer struggled to find employment and, facing financial difficulties, was forced to dig into his provident fund? Well, SARS may have sympathy with such taxpayers and may allow the pre-retirement withdrawal amount to be treated in the same way as a lump sum paid out at normal retirement. In this case, we would enter the code 3920 amount in either the retrenchment column or in the retirement column, where the first 500,000 Rand tax-free set of tables would apply. So far, we've seen how Code 3920 amounts are taxed according to the circumstances surrounding how the lump sum was withdrawn, paid out, or even transferred to a preservation fund. You have the choice in WinTax as to where you enter the amount according to how the lump sum is to be taxed. However, there's only one place on the ITR 12 to show a Code 3920 amount, and SARS is supposed to work out how the amount must be taxed according to the directive SARS issued. Sometimes SARS gets this wrong, and then you'll have to lodge an objection and submit the necessary documentation to support your case. To summarize, you can see that a Code 3920 lump sum is one of the lump sums that can be taxed in a few different ways depending on the circumstances surrounding the lump sum payout or withdrawal. SARS has adopted an accumulative method of taxing multiple lump sums received. We must add together all lump sums received in the tax year, and the accumulated total will be taxed using a set of tables applicable to the lump sum which you indicate as having been taken last in the current tax year. You have control over which set of tables WinTax will use, and whichever T you select will decide the set of tax tables to be used. In cases where more than one lump sum was taken in this current year, then you must set the T to the set of tables applicable to the lump sum taken last. Switching between selecting these new T buttons allows you to switch between tax tables used on the total of all lump sums taken. With different lump sums received maybe days apart in this current tax year, this may prove useful in matching the figures produced by SARS's choice of tables used. Let's say our taxpayer went on pension from a pension fund and also made a withdrawal of some of his provident fund, preferring to take the rest of the provident fund sometime in a future tax year. Let's say this taxpayer received a Code 3915 lump sum of 500,000 Rand from his pension fund and also decided to take a Code 3920 withdrawal of 100,000 Rand from the Provident Fund, all in the current tax year. The Code 3920 pre-retirement withdrawal of 100,000 Rand from the Provident Fund is entered in the resignation column. The 500,000 pension lump sum is shown in the retirement column. As this 500,000 Rand pension lump sum was taken last in the tax year, we have selected the T button in the retirement column. This means the retirement benefit tax tables will be used for the accumulative total of the lump sums. We now have to use the same set of retirement tables to work out the tax on all lump sums taken prior to the lump sum taken last. This means we apply the retirement tables to the 100,000 Rand. Now the first 500,000 of the 100,000 withdrawal amount is tax-free, so no tax is levied on the 100,000 Rand. Note that it is completely irrelevant what tax was actually levied on the 100,000 Rand withdrawal when it was paid out. So we have tax of 18,000 Rand on the 600,000 Rand total, less no tax on the 100,000 Rand withdrawal, which means tax of 18,000 Rand due. Let's have a look at the auto summary. The total of 600,000 less 500,000 tax-free means the balance of 100,000 is taxed at 18%, which means tax of 18,000 on the lump sum taken. What about a new case where the taxpayer went on pension last year and received a lump sum of 1.2 million from the pension fund? He then made a pre-retirement withdrawal of 500,000 Rand from his Provident Fund this year. The same rules apply as SARS's accumulative method of taxing lump sums also extends across tax years. All the lump sums are added together, and the set of tables used is the set of tables applicable to the lump sum taken or received last in this current tax year. The lump sum taken last was the 500,000 received as the withdrawal from the Provident Fund. The total of all lump sums taken this year and in all previous tax years after 2009 is 1.7 million, taxed as per the withdrawal tables. The tax on 1.7 million is 459,000 Rand, less the tax that would or should have been due on the 1.2 million. It is irrelevant to the calculation what tax was actually paid on the lump sum taken previously. For the sake of this calculation, we credit the tax due of 459,000 on the 1.7 million total with the tax on the 1.2 million taxed using the same withdrawal tables. The tax on 1.2 million using the withdrawal tables will be 279,000 Rand. Subtracting the 279 from the 459 means that the tax due on the 500,000 Rand taken this year is 180,000 Rand. Let's have a look at the auto summary screen. The auto summary screen shows that the tax due on the lump sum taken this year will be 180,000 Rand. What if we reverse these amounts and we say that the taxpayer received a lump sum withdrawal of 500,000 Rand last year and received a 1.2 million Rand from his pension fund when he retired this year? Once again, we work out the tax on all the lump sums added together, but this time we use the retirement set of tables on the accumulative 1.7 million total. The tax is 364,500. From this, we have to subtract the tax on the 500,000 Rand lump sum taken last year, but using the same retirement set of tables we used for the total. As this set of tables offers the first 500,000 Rand tax-free, the tax on the withdrawal amount taken last year will be 0. Therefore, tax on the 1.2 million amount taken this year will be 364,500 Rand less 0. And here you can see the auto summary agrees with us. One more example I'd like to show is where a taxpayer received a 300,000 Rand lump sum on retiring from his pension fund last year and made a 200,000 Rand withdrawal from his provident fund this year. One would be mistaken in thinking that after receiving the 300,000 Rand retirement amount last year, that our taxpayer was still entitled to another 200,000 Rand tax-free in future. This would be true if the lump sum taken in future was also a retirement lump sum. Remember that the first 500,000 Rand tax-free only applies to retirement lump sums. There are a few other lump sum codes you may come across. Code 3908 concerns fund benefits not claimed before and is non-taxable. Code 3909 concerns unclaimed fund benefits withdrawn and is taxable. Code 3921 concerns a lump sum paid out from a fund such as a living annuity fund when the amount left in the fund decreases to 50,000 Rand. At this level, the admin fees would exceed any growth or income generated by the 50,000, so the entire balance of the taxpayer's annuity is paid out as a Code 3921 lump sum. If a taxpayer goes on pension and the taxpayer's total amount in a pension or RA fund is 75,000 or less, then the entire amount in the fund may be paid out as a Code 3915 lump sum. The 50,000 Rand 2/3 portion normally placed into an annuity would not be financially sustainable for the same reasons, and so the entire amount is paid out, usually tax-free, as a Code 3915 amount. The lump sum received from a retirement fund, as shown on the tax certificate from the fund, may not necessarily be the amount you need to enter into WinTax. In the case of a state or quasi-government employee, lump sums from state pension funds were all tax-free before 1st of March 1998. After this date, the same rules apply to them as apply to everybody else. In the case of these state employees, The lump sums received from the state pension fund must be proportioned by their periods of pensionable service before and after 1st of March 1998. Only the portion of the lump sum attributable to the period of their pensionable service after 1st of March 1998 must be entered into WinTax, where the normal tax tables for retirement lump sums will apply to the amount you enter. In cases where tax relief was not allowed on any portion of the contributions made to a retirement fund when the contributions were made, then those amounts which did not qualify for tax relief may be deducted from the lump sum before you enter the lump sum into WinTax. This includes all contributions made to provident funds and any portion of contributions made to pension or RA funds which could not be claimed because the contributions exceeded the limits for claims at the time when the contributions were made. In a case like this, either the directive issued by SARS or the retirement fund itself should be able to tell you the amount which can be subtracted from the lump sum before entering it into WinTax. If you move all the money in your pension, RA or provident fund to a preservation fund, then there are no tax implications involved in this transfer. Any withdrawals that you may be allowed to make from the preservation fund are subject to the same laws and tax tables which affect withdrawals from pension, provident and RA funds. The laws which govern the original fund apply to the lump sum taken from the preservation fund when you eventually retire from the preservation fund. In other words, if you moved your pension fund money into a pension preservation fund, then when you retire from the pension preservation fund, 1/3 may be paid out as a lump sum and 2/3 must be commuted to an annuity. If you moved your provident fund money to a preservation fund, then when you retire from the preservation fund, the entire amount in the provident preservation fund may be paid out as a lump sum.